Is the Reliance Nippon Life Super Assured Future Endowment Plan truly the safe investment option you have been searching for, or does it fall short compared to other investment plans available in the market? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. This is a non-linked, non-participating individual savings life insurance plan. Some of the key features of the policy are: it offers you comprehensive insurance protection throughout the policy term. You get to receive a lump sum amount at maturity to help you meet your key financial goals, and you can also boost your maturity benefit with guaranteed additions and guaranteed loyalty additions. And you get to choose you to receive your maturity payout as regular income over 5, 10 or 15 years through the settlement option, and you can also select a premium payment term of 5, 7, 8, 10 or even 12 years based on your financial comfort. And you can enhance your coverage by adding riders for additional protection against life's uncertainties. And you also can enjoy potential tax benefits as per the prevailing income tax laws. And there are benefits like death benefit, maturity benefit, guaranteed additions, and guaranteed loyalty additions. So if you want to know more about these aspects of the policy in detail, you can refer to the policy brochure. Now let us take a look at the advantages and disadvantages of investing in this policy. Let's start with the advantages. So you can choose to convert part or all of your maturity benefit into a regular stream of income over a selected period, or borrow up to 70% of the surrender value under the base plan if you need liquidity, and also pay your premiums annually, half yearly, quarterly or monthly, whichever suits your convenience. And you can also enhance your policy coverage by adding rider benefits to the base plan. So these are some of the advantages. The disadvantages, however, are the yearly increase in the sum assured does not provide any meaningful benefit to the policyholder, and although the maturity benefit is guaranteed, the overall returns are modest and not very attractive. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding of this policy, let us move on to the analysis part of the video. Because before investing, it is crucial to evaluate the plan's returns in percentage terms to assess its true value to help us make an informed decision. That's why we are going to conduct a IRR analysis, which is we are going to calculate the internal rate of return of this policy based on the benefit illustration given in the policy brochure. So for an example purpose, let us assume that a 35-year-old male has opted for the SAFE plan with a base sum assured of 9,54,836 rupees. The death benefit starts at 11 lakhs and increases every year from the second policy year over a 20-year policy term. So the policyholder pays an annual premium of 1 lakh. At maturity, he receives a total benefit of 21 lakhs including guaranteed additions. So the internal rate of return IRR for this investment is 4.84% as per the policy's maturity calculator, which is lower than what typical debt instruments offer. The modest returns are primarily due to a large portion of the premium being used to fund the increasing life cover, leaving a limited amount for actual investment growth. As a result, the Reliance Nippon Life SAFE plan proves to be suboptimal both as an insurance solution and as an investment avenue. So the rigid cash flow structure, rising death benefit and the modest returns make this policy less appealing to many investors. A clearer decision can be made by comparing its returns with alternative options using the same example metrics. So in the SAFE plan, the sum assured increases annually, whereas if we opt for a pure term life insurance policy for life cover purpose instead, it can provide a fixed life cover throughout the term. So for instance, a 20-year policy plan can offer you 22 lakhs in coverage, roughly equal to the highest sum assured in the yearly example of Reliance policy. But it will cost us an annual premium of just 14,100 rupees per year, which compared to Reliance policy, we were paying 1 lakh there. So this leaves us with an annual surplus of 85,900 rupees. rupees that can be invested based on a risk appetite. So if you are a low risk investor, you may prefer traditional debt instrument like the public provident fund PPF, and if you are a growth oriented investor, you may opt for market linked products like the equity linked savings schemes ELSS. So for this comparison, we are going to consider both the options. So the PPF investment was adjusted to meet the minimum 15-year contribution rule. At the end of 20 years, the account grows to 25.34 lakhs, yielding an IRR of 6.09%. So the ELSS fund, on the other hand, could accumulate to 52.43 lakhs, which is the pre-tax value, and after deducting the capital gains tax, the post-tax value stands at 47.11 lakhs with a post-tax IRR of 10.24%. In both scenarios, the returns significantly outperform those of the Reliance policy. So this clearly demonstrates that keeping insurance and investments separate is a more efficient strategy for long-term wealth creation, helping you reach your financial goals faster. So what is the final verdict on Reliance Nippon Life Super Assured Future Endowment Plan? So this policy features an annually increasing death cover throughout the policy term. While this may be positioned as a key benefit, in practical financial planning, it isn't necessary for the life cover to increase every year. What truly matters is having a sum assured that adequately covers your future financial goals, life goals, and outstanding liabilities. So additional life cover is typically only needed during major life events such as marriage, the birth of a child, or taking on new financial responsibilities, not as a built-in annual increment. This automatic increase adds no real value to the policyholder, and it also has a huge agent commission. So instead, it contributes to higher premium cost without proportionate benefits. The plan's written analysis further confirms it is a low yielding product. So despite offering guaranteed benefits, the overall returns are unattractive for long-term investors. A more effective approach is to opt for a pure term life insurance policy, sufficient sum assured to cover all your future obligations. So when your financial situation changes, you can reassess and increase your cover accordingly. For building wealth and meeting long-term goals, it's far better to invest in a well-diversified portfolio separately aligned, which is aligned with your risk profile.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.